Hello everyone, North Star VFD Consultancy welcome you to another chapter on Introduction to International Financial Reporting Standards. This video is part 3, IAS1, Presentation of Financial Statements. In previous video of part 1 and 2 of IAS1, we discussed IAS1 standards, history, its objective, scope and scope limitation, purpose, complete set of financial statements, general features of financial statements, structure and minimum content required in statement of financial position. In this chapter we will discuss structure and minimum content requirements for performance statements, that is profit and loss and other comprehensive income. We discussed about statement of financial position, now we will look into statement of profit or loss and other comprehensive income. First, let us look into concept of comprehensive income. IAS1 requires a performance statement should show not only realized profit, in addition to that, all changes in net assets, other than contribution and return of capital, and calls it a statement of comprehensive income. Total comprehensive income is defined by IAS1 as the change in equity during a period resulting from transactions and other events, other than those changes resulting from transactions with owners in their capacity as owners. It comprises all components of profit or loss and of other comprehensive income. In other words, total comprehensives include two broad items. 1. Profit or loss, that is total of income less expenses, and 2. Other comprehensive income, comprises items of income and expense, including reclassification adjustments, that are not recognized in profit or loss, as required or permitted by other IFRSs. What this means is that, profit and loss is the default category, all comprehensive income is part of profit and loss, unless a provision of IFRS say it is or may be other comprehensive income. An entity have choice to present its performance statement either a single statement of profit or loss and other comprehensive income in two sections, or two separate statements, one statement of profit or loss and a separate statement of comprehensive income. An entity should present, in addition to the profit or loss and other comprehensive income, an allocation of profit or loss as well as other comprehensive income for the period, attributable to non-controlling interests and to owners of the parent. Earlier we mentioned that an entity has choice to present performance statement. Please refer to sample performance statement displayed here. You may note that first performance statement is following single statement approach, that means single statement with first section of profit and loss and second section of other comprehensive income. Second performance statement following two statement approach, first statement of profit and loss and second statement of comprehensive income. Information to be presented in the profit or loss section. As is the case for the statement of financial position, IAS1 sets out certain items which must appear on the face of the statement of profit or loss, and other required disclosures which may be made either on the face or in the notes. The statement of profit or loss should include line items that present the following amounts for the period. 1. Revenue, presenting separately. A. Interest revenue calculated using the effective interest method, and B. Insurance revenue as required by IFRS 17. 2. Gains and losses arising from the derecognition of financial assets measured at amortized cost. 3. Insurance service expenses from contracts issued within the scope of IFRS 17. 4. Income or expenses from reinsurance contracts held, as required by IFRS 17. 5. Finance costs. 6. Impairment losses, including reversals of impairment losses or impairment gains, determined in accordance with IFRS 9. 7. Insurance finance income or expenses from contracts issued within the scope of IFRS 17. 8. Finance income or expenses from reinsurance contracts held, as required by IFRS 17. 9. Share of the profit or loss of associates and joint ventures accounted for using the equity method. 10. Any difference between fair value and the previous carrying amount at the date of reclassification, when a financial asset is reclassified out of the amortized cost category to be measured at fair value through profit or loss, as required by IFRS 9. 11. Any accumulated gain or loss previously recognized in other comprehensive income that is reclassified to profit or loss, when a financial asset is reclassified out of the fair value through other comprehensive income category so that it is measured at fair value through profit or loss. 12. Tax expense. 13. A single amount comprising the total of the post-tax profit or loss of discontinued operations, and the post-tax gain or loss recognized on the measurement to fair value less costs to sell, or on the disposal of the assets, or disposal groups constituting the discontinued operation, according to IFRS 5. 14. Profit or loss. 15. Allocation of profit or loss for the period, to non-controlling interest and to owners of parent. The face of the statement of comprehensive income. Each item of comprehensive income and, separately, the items in the share of other comprehensive income of associates and joint ventures accounted for using the equity method, should be presented in two groups, one including items which may subsequently be reclassified into profit or loss and another including items which will not. Whether presented as a separate statement or as a section of a combined statement, the face of the statement of comprehensive income should present items stated below. A. Profit or loss. If two statements are presented, this will be a single line item. B. Each item of comprehensive income, classified by nature, which include 1. Changes in revaluation surplus relating to property, plant and equipment and intangible assets. 2. Remeasurements on defined benefit plans in accordance with IAS 19. 3. Gains and losses arising from translating the financial statements of a foreign operation. 4. Gains and losses from investments in equity instruments designated at fair value through other comprehensive income. 5. Gains and losses on financial assets measured at fair value through other comprehensive income. 6. The effective portion of gains and losses on hedging instruments in a cash flow hedge, and the gains and losses on hedging instruments that hedge investments in equity instruments measured at fair value through other comprehensive income. 7. For particular liabilities designated as at fair value through profit and loss, fair value changes attributable to changes in the liability's credit risk. 8. Changes in the value of the time value of options, when separating the intrinsic value and time value of an option contract, and designating as the hedging instrument only the changes in the intrinsic value. 9. Changes in the value of the forward elements of forward contracts, when separating the forward element and spot element of a forward contract and designating as the hedging instrument only the changes in the spot element, and changes in the value of the foreign currency basis spread of a financial instrument when excluding it from the designation of that financial instrument as the hedging instrument. 10. Insurance finance income and expenses related to insurance or reinsurance contracts, which is excluded from profit or loss in certain circumstances in accordance with IFRS 17 insurance contracts. 11. The aggregate amount of tax relating to components of comprehensive income, unless the components are shown individually net of tax. Tax should be allocated between the two groups. C. Share of the items of other comprehensive income of associates and joint ventures accounted for using the equity method. D. Reclassification adjustments, unless the components of comprehensive income are shown after any related reclassification adjustments, and E. Total comprehensive income. In a separate statement of other comprehensive income, IAS1 also requires an analysis of total comprehensive income for the period between that attributable to non-controlling interests and owners of the parent. As we have discussed, items to be presented on the fact of statement of profit and loss and other comprehensive income, let us look into other requirements relevant to profit and loss and other comprehensive income. Other requirements. An entity shall present additional line items, headings and subtotals in the statements presenting profit or loss and other comprehensive income when such presentation is relevant to an understanding of the entity's financial performance. An entity shall not present any items of income or expense as extraordinary items in the statements presenting profit or loss and other comprehensive income or in the notes. An entity shall recognize all items of income and expense in a period in profit or loss unless an IFRS requires or permits otherwise. Information to be presented in the statements of profit or loss and other comprehensive income or in the notes. When items of income or expense are material, an entity shall disclose their nature and amount separately. Circumstances that would give rise to the separate disclosure of items of income and expense include the following. 1. Write-downs of inventories to net realizable value or of property, plant, and equipment to recoverable amount, as well as reversals of such write-downs. 2. Restructurings of the activities of an entity and reversals of any provisions for the costs of restructuring. 3. Disposals of items of property, plant, and equipment. 4. Disposals of investments. 5. Discontinued operations. 6. Litigation settlements, and 7. Other reversals of provisions. Expenses recognized in profit or loss should classify either on their nature of expense or their function of expense within the entity, whichever provides information that is reliable and more relevant. An entity classifying expenses by function shall disclose additional information on the nature of expenses, including depreciation and amortization expense and employee benefits expense. The choice between the function of expense method and the nature of expense method depends on historical and industry factors and the nature of the entity. This is end of this video. Thank you for watching, and see you next time with another video on IFRS.